Most traders believe the market is their problem. They think they need better indicators, better strategies, better timing. But Mark Douglas discovered something different. The problem is not the market. The problem is you. More specifically, the problem is how you think about the market, how you react emotionally, how your beliefs control your behavior. This is not about motivation. This is about psychological truth. Douglas spent decades studying why traders fail. He found that nearly all trading problems come from the same source: emotions, but not the way you think. Emotions are not the enemy. Emotions are messengers. They tell you about your beliefs, your fears, your expectations. When you understand this, everything changes. Today, we will examine 10 emotions that destroy trading careers. We will go deep into each one. We will look at the pain they cause, the behavior they create, and most importantly, the psychological root beneath them. This is Mark Douglas' framework, his wisdom, his clarity. By the end, you will understand why you keep sabotaging yourself, and you will know exactly how to stop. Let's begin. Before we examine specific emotions, you must understand the pattern. Every trading mistake follows the same sequence. First, an emotion arises: fear, greed, hope. It does not matter which one. Second, this emotion creates pain, psychological pain, discomfort, anxiety, a feeling you want to escape. Third, to escape the pain, you take action. You exit too early. You hold too long. You chase. You freeze. This behavior feels like it will reduce the pain, but it actually guarantees failure. Why? Because the behavior comes from emotion, not probability. From fear, not logic. From a need to feel better, not a need to trade correctly. Mark Douglas called this the fundamental problem in trading. Traders make decisions to manage emotional pain instead of managing risk. The market does not care about your pain. The market does not reward you for feeling comfortable. The market only rewards probabilistic thinking and disciplined execution. So if your decisions come from a need to feel better, you will lose. Every single time. This is the harsh truth. Now let us look at each emotion specifically. Fear is the most common emotion in trading. It shows up everywhere. Fear of losing, fear of being wrong, fear of missing out, fear of giving back profits. But what is fear really? Mark Douglas explained that fear is not about the market. Fear is about you, about your beliefs, about what you think losing means. Most traders believe that losing money means something terrible. It means they failed. It means they are incompetent. It means they wasted time and effort. This belief creates intense fear. When you place a trade, you are not just risking money. You are risking your self-image, your identity, your sense of competence. And when the trade moves against you, the fear becomes overwhelming. So what do? You exit too early. You move your stop. You refuse to take trades even when your edge is present. All of this feels like protection, but it guarantees failure. Why? Because trading is a probability game. Douglas taught that any individual trade is meaningless. It is just one outcome in a random distribution. Sometimes your edge wins. Sometimes it loses. You cannot know which trades will win before they happen. But fear makes you treat every trade as if it is life or death, as if this one trade determines your worth as a trader. This is the psychological root. You have attached your identity to the outcome. Here is Mark Douglas' fix for fear. Douglas offered a simple but profound solution. Accept uncertainty. The market is uncertain. Outcomes are random. You cannot control which trades win or lose. But you can control one thing: your execution. When you accept that losing is part of trading, fear loses its power. Losing no longer means you are incompetent. It just means the probability did not favor you this time. Douglas called this thinking in probabilities. You stop asking, will this trade win? And start asking, am I executing my edge consistently? When you make this shift, fear dissolves. You are no longer afraid of being wrong. Because being wrong is not a problem. It is expected. This is the only way to trade without fear. Let's understand greed. Greed appears during winning trades. The trade is in profit. Your edge says exit, but you do not exit. You hold. You hope for more. And very often, the profit disappears. Most traders call this greed. But Mark Douglas saw something deeper. Greed is not about wanting money. Greed is about emotional attachment to the outcome. When a trade moves in your favor, you feel pleasure, excitement, satisfaction. Your brain releases dopamine. You feel powerful, in control, and you want that feeling to continue. So you ignore your rules. You tell yourself the trade will keep moving. You create stories about why this trade is special. But the market does not care about your stories. Douglas explained that traders who hold winning trades too long are trying to control the uncontrollable. They believe they can squeeze more profit out of the market through willpower. This is an illusion. The market moves according to the collective beliefs and actions of all participants, not your desires, not your need for validation. When you overstay a winning trade, you are no longer trading your edge. You are trading your emotions. Douglas taught that you must detach from outcomes. Every trade is just one execution in a series. This trade does not define you. It does not prove anything. Your job is not to maximize every single trade. Your job is to execute your edge consistently over time. When you have this mindset, greed disappears. You exit when your system says exit, not because you are afraid of giving back profit, but because you trust the process. Douglas often said, the market will give you what it wants to give you, not what you want to take. Accept this. Follow your rules. Let the probabilities work over time. This is how you defeat greed. FOMO appears when the market moves without you. You see a stock breaking out. You see other traders making money. You feel left behind. So you chase. You enter without confirmation. You take trades outside your system. You abandon your discipline. And you lose. Mark Douglas understood FOMO as a specific type of fear. The fear of missing opportunity. The fear of being excluded from profits. But here is the truth Douglas revealed. FOMO is based on a faulty belief. You believe that missing this trade means missing opportunity. But the market creates infinite opportunities. Every single day, there is no last trade. There is no only chance. The belief that this moment is special creates the pain of missing out. And that pain drives irrational behavior. Douglas also pointed out something critical. The outcomes you see are not random. They are selected. You see the trades that worked, the breakouts that continued, the winners that other traders posted. You do not see the failures, the false breakouts, the losses. This creates a distorted perception. You think every move is an opportunity, but most moves are noise. Mark Douglas taught that you must accept the random distribution of outcomes. Some opportunities will pass you by. This is guaranteed, and it is fine. Your edge does not require you to catch every move. Your edge only requires consistent execution when your setup appears. Douglas often reminded traders, missing a trade is not a mistake. Taking a trade outside your system is a mistake. When you internalize this, FOMO loses its grip. You stop chasing. You stop feeling urgency. You wait for your edge, and you trust that the market will give you plenty of opportunities. Patience is not about controlling yourself. It is about trusting the process. Now let's move to one of the most dangerous emotions in trading. Hope. It appears when a trade moves against you. Your stop-loss level is clear. The trade has failed, but you do not exit. You hope it will come back. You hope the market will reverse. You hope you can avoid the loss. Mark Douglas called hope the trader's worst enemy. Why? Because hope is a refusal to accept reality. The market is telling you something. The price action is clear. Your trade is wrong. But you reject this information. You replace reality with fantasy. You create stories. Maybe the market is overreacting. Maybe it will bounce. Maybe it is just a temporary dip. But these stories are not based on evidence. They are based on your need to avoid pain. Douglas explained that holding losing trades is not about hope for profit. It is about hope for avoiding the pain of being wrong. Losing feels bad. Admitting you were wrong feels bad. So you postpone the pain by holding the trade. But this makes the pain worse. The loss grows. The psychological damage increases. And you reinforce a destructive pattern. Douglas taught a fundamental principle. Accept what the market is offering. The market does not care about your hopes. It does not care about your entry price. It does not care if you lose. When a trade goes against you, the market is giving you information. It is telling you the probability did not favor this trade. Accept it. Exit. Move on. Douglas often said, the market is never wrong. Your analysis can be wrong. Your timing can be wrong. But the market simply is. When you accept this, hope transforms. You stop hoping for the market to change. You start accepting what is happening. This is psychological maturity. And it is the only way to cut losses quickly. Frustration appears when the market does not behave the way you expect. You analyzed correctly. You followed your rules. But the trade lost. Or worse, you waited patiently. But the market never gave you a setup. No opportunity. Just noise. This creates frustration, anger, a feeling of injustice. Mark Douglas understood this emotion deeply. Frustration comes from a core belief. The market should reward your effort, your patience, your discipline. But the market does not work this way. The market is not fair. It does not care about your effort. It does not owe you anything. Douglas explained that frustration is always a conflict between expectation and reality. You expect the market to behave a certain way. You expect your analysis to be right. You expect your discipline to guarantee profit. But the market operates on probability, not certainty. When your expectations collide with reality, you feel frustrated. And this frustration drives destructive behavior. You force trades. You enter without confirmation. You abandon your rules. You feel like you deserve a win, so you take a low-probability trade. This is how frustration destroys accounts. Here is the fix for frustration. Douglas taught that you must eliminate expectations about specific outcomes. You cannot expect to win today. You cannot expect the market to give you a setup. You cannot expect your analysis to be correct. You can only expect one thing: that your edge will work over time if you execute it consistently. Douglas often reminded traders, the market does not give you what you deserve. It gives you what it gives you. When you accept this, frustration disappears. You stop being angry at the market. You stop feeling entitled to wins. You simply execute, over and over, without attachment. This is freedom. Overconfidence appears after a series of wins. You have made 5 winning trades in a row. You feel invincible, skilled, in control. So you start taking larger positions. You bend your rules. You take trades outside your system. And suddenly, you give back all your profits. Mark Douglas identified overconfidence as one of the most subtle dangers in trading. Why? Because winning feels like proof. Proof that you are skilled. Proof that you understand the market. Proof that you can predict outcomes. But this is an illusion. Douglas explained that winning does not prove skill. Winning proves that the probability favored you recently. Your edge has a win rate. Maybe 60%, maybe 50%, but it is never 100%. When you win 5 trades in a row, you have not become a better trader. You have simply experienced a random cluster of wins. But your brain does not see it this way. Your brain sees winning as proof of competence. This inflates your ego. And your ego tells you that you can break rules without consequences. This is when overconfidence destroys you. Douglas taught that you must separate outcomes from execution. Winning does not mean you traded well. Losing does not mean you traded poorly. What matters is execution. Did you follow your rules? Did you trust your edge? Did you manage risk? If yes, then you succeeded, regardless of the outcome. Douglas often said, the quality of your trading is measured by your consistency, not your profits. When you adopt this mindset, overconfidence cannot take root. Winning does not change who you are. It is just one outcome in a series. You stay humble. You stay disciplined. You keep following your process. This is the mark of a professional trader. Regret appears after a missed opportunity or a loss. You did not take the trade, and it would have been a big winner. Now you feel terrible, angry at yourself, stupid, or you took a trade. It lost, and now you replay it endlessly. What if you had exited earlier? What if you had not entered at all? Mark Douglas saw regret as a particularly destructive emotion. Why? Because regret keeps you trapped in the past. And when you are trapped in the past, you cannot trade in the present. Douglas explained that regret is based on a faulty belief. You should have known. But the market is uncertain. You cannot know which trades will win before they happen. Missing a winner is not a failure. It is part of trading. Your edge does not require you to catch every move. Similarly, taking a loss is not a mistake. It is part of the probability distribution. But when you feel regret, you create a new problem. You start hesitating. You doubt your future decisions. You second-guess your edge. This hesitation causes you to miss the next good trade, which creates more regret. And the cycle continues. Douglas taught that you must let go of past outcomes. Every trade is independent. What happened yesterday has no bearing on what will happen today. The market does not remember your losses. It does not care about your missed trades. Douglas often reminded traders, the past does not equal the future. When you accept this, regret loses its power. You stop replaying old trades. You stop wishing you had done something different. You focus on the present moment, the current setup, the current execution. This is the only way to trade with clarity. Impatience appears when the market moves slowly. You are waiting for a setup, but nothing happens. Minutes turn into hours. Hours turn into days. You feel restless, bored, uncomfortable. So you take a trade, not because your edge appeared, but because you need stimulation. Mark Douglas identified impatience as a signal of deeper psychological issues. Why? Because impatience reveals a need for action, a need to feel like you are doing something, a need for excitement. But trading is not about action. Trading is about execution. Douglas explained that impatience comes from a belief that trading should be exciting, that you should be active, that sitting and waiting is not really trading. But the opposite is true. The best traders spend most of their time waiting. They do nothing. They watch. They wait for their edge to appear. And when their edge appears, they act without hesitation. Impatience destroys this process. It makes you take trades before your edge appears. It makes you enter too early. It makes you trade for entertainment instead of profit. Douglas taught that you must redefine what trading means. Trading is not about activity. It is about discipline. Waiting for your setup is trading. Doing nothing when there is no edge is trading. Sitting in front of your screen with no positions is trading. Douglas often said, "The market will let you know when it is time to trade." When you internalize this, impatience disappears. You stop needing action. You stop feeling bored. You accept that most of the time, the right thing to do is nothing. This is mastery. Revenge trading appears after a loss. You lost money. You feel angry, hurt, cheated. So you take another trade immediately, not to execute your edge, but to get your money back. Mark Douglas called revenge trading one of the clearest examples of emotional self-sabotage. Why? Because revenge trading is not trading at all. It is an emotional reaction. Douglas explained that revenge trading comes from a specific belief. The market took something from you. But this belief is false. The market did not take anything. You took a risk. The probability did not favor you. That is all. The market is not your enemy. It is not trying to hurt you. It has no awareness of you. But when you lose, your ego feels attacked. You personalize the market. You believe it wronged you. And your ego demands retaliation. So you take a trade to get even, to prove you are right, to recover what was stolen. But the market does not care. And this trade, driven by emotion, almost always loses, which creates more anger, more revenge, more losses. This is the death spiral of revenge trading. Douglas taught that you must depersonalize the market. The market is not your opponent. It is a neutral environment. It simply reflects the collective beliefs and actions of millions of participants. When you lose, you have not been attacked. You have simply experienced one outcome in a random distribution. Douglas often reminded traders, the market does not know you exist. When you accept this, revenge trading becomes impossible. You cannot take revenge on something that has no awareness of you. You let the loss go. You move on. You wait for the next opportunity. This is psychological freedom. Doubt appears when you do not trust your edge. Your setup appears. Your rules say enter. But you hesitate. What if it fails? What if you are wrong? What if this is a false signal? So you do not take the trade. And it wins. Big. Mark Douglas identified doubt as the final barrier to consistency. Why? Because doubt prevents execution. And without execution, your edge cannot work. Douglas explained that doubt comes from a lack of belief. You do not truly believe in your edge. You do not trust that it will produce positive results over time. This doubt usually comes from past pain, past losses, past failures. Your mind remembers every time you followed your rules and lost. And it uses this memory to create fear. But here is what your mind forgets. Your edge is a probability. It does not work every time. It works over time. When you doubt your edge, you start picking and choosing trades. You take the ones that feel safe. You skip the ones that feel risky. But this destroys your edge because you are no longer executing consistently. And without consistency, you cannot trust the probabilities. Douglas taught that you must build unshakable belief in your edge. How? Through consistent execution, over and over, regardless of outcomes. Douglas explained that belief comes from experience. You must execute your edge enough times to see the probability distribution unfold. You must see that sometimes it loses, sometimes it wins. But over time, it produces positive expectancy. This requires discipline. You cannot skip trades. You cannot pick and choose. You must execute every signal. Douglas often said, the only way to trust your edge is to prove it to yourself through consistent execution. When you do this, doubt disappears. You stop second-guessing. You stop hesitating. You see a setup. You execute. You let the probability work. This is the final step to mastery. We have examined 10 emotions that destroy trading careers. Each emotion creates pain, and that pain drives destructive behavior. But now you understand the pattern. And understanding is the first step toward change. Mark Douglas spent his life teaching one fundamental truth. The market is not your problem. Your mindset is your problem. The market is neutral. It does not reward or punish you. It simply moves according to probability. Your job is not to predict the market. Your job is to execute your edge consistently. When you do this, outcomes take care of themselves. But to execute consistently, you must change your beliefs. You must accept uncertainty. You must think in probabilities. You must detach from outcomes. This is not easy. Your brain is wired to seek certainty, to avoid pain, to create stories. But you can train your brain. You can build new beliefs. You can develop a new relationship with the market. Douglas taught that trading mastery is not about finding the perfect strategy. It is about mastering yourself. When you master your emotions, when you trade from a place of psychological clarity, when you trust your edge and execute without hesitation, you become a professional trader. The market will still be uncertain. Trades will still lose. But you will no longer be afraid. You will no longer sabotage yourself. You will simply execute, over and over, with discipline, with patience, with trust. This is the path forward. This is what Mark Douglas taught. And this is how you become the trader you were meant to be. Accept uncertainty. Think in probabilities. Execute consistently. The rest will follow.